We build a solution to value businesses for SBA lending purposes. And what that means is it's when a small business, like a legacy business or a business owned by a baby boomer, someone comes in to acquire that business rather than it being passed down to the next generation and staying with a family business. And so the most common use of funds to purchase that business would be an SBA loan. So the US Small Business Administration finances those deals to help stimulate the economy. And specifically small businesses. And part of that, there is a requirement to purchase a business valuation to determine to right size the loan and determine what the business is actually worth, to make sure the borrower is not overextending themselves and make sure that the bank is mitigating that risk.
Hey everyone, welcome back to the Ignite podcast. Today we're thrilled to have Cameron Long on the program. He's the co-founder and COO for ValueBuddy. This is a fintech company we recently invested in that's leveraging AI to revolutionize business valuations for SBA loans. His background in management consulting and financial analysis, deep understanding of how small businesses transact. These inefficiencies have plagued the lending process. Turns out all these small businesses need to get valuations, and it's quite the journey. So we'll discuss his journey into ValueBuddy and how it's transforming business valuations and what the future of AI-powered underwriting looks like. Thanks for coming on, Cameron.
Yeah, thanks for having me, Brian.
You know, it's funny to tell the backstory. We originally passed on you guys, I think, a year or two ago, and we kind of met you guys. You weren't full-time yet. You're still consulting, working for ValueBuddy part-time. I was like, it's just early, right? And then you guys just kept grinding, kept sending me updates. Maybe you could talk about your personal and professional journey into founding ValueBuddy and kind of tell that story.
ValueBuddy actually kind of started as a side project for me and my co-founder Ace. And I think that's actually one of kind of the magical thing about if you're in an enterprise role and there's a real pain point with your job, trying to address that pain point often leads to a pretty good B2B enterprise solution. Probably one of the easier ways to birth a B2B product is just solving a pain point in your day-to-day life. And so Ace initially started ValueBuddy. He was at Brown Forman as a financial analyst and kind of in a manager position. So a lot of his job was looking at pricing of a bunch of different products, valuing product line extensions. All of that was done manually, even at a $10 billion private or publicly traded company. And so he saw a need to kind of automate a lot of that financial analysis. And then later on, when he was still kind of widget, he met me, and my background was more in the investment banking, private equity management consulting side. And so I really doubled down on the business valuation component of that product. From there, we started working with startups for business valuations when they're fundraising, 9A valuations. We had some success. There wasn't really a huge pain point in the market. People like Carta were already kind of churning out low quality, cheap, or even free business valuations for those needs. It took a lot of education, so it just didn't really scale well. And so then that's when we took a step back. We looked for, what area of the market has, larger pain points? Where is the willingness to pay higher? Is there somewhere that we can aggregate demand where someone might need 100 business valuations a year or even 1,000, as opposed to needing them once per year, like a 409A valuation? And through that exploration and speaking with others in the market, that's where we found SBA lenders. And so starting at the beginning of 2024, that's where we went all in on SBA lending. We built a solution to value businesses for SBA lending purposes. And what that means is it's when a small business, like a legacy business or a business owned by a baby boomer, someone comes in to acquire that business rather than it being passed down to the next generation and staying with a family business. And so the most common use of funds to purchase that business would be an SBA loan. So the US Small Business Administration finances those deals to help stimulate the economy and specifically small businesses. And part of that, there is a requirement to purchase a business valuation to determine to right size the loan and determine what the business is actually worth, to make sure the borrower is not overextending themselves and make sure that the bank is mitigating that risk.
Like an appraisal when you buy a house, more or less.
Exactly.
The bank wants to make sure that, hey, we're going to give you some percentage of this business value as a loan so you can go buy it, and you're going to pay it off with future cash flows, but we want to make sure we're not lending too much.
Exactly. And that becomes a risk if they do kind of overlend, and the borrower often has a personal financial guarantee. So their house might be on the line. It's pretty high stakes from a business value.
SBA will sometimes have personal guarantees with equity in your home and things.
Definitely. Yeah.
Wow. Oof.
Yeah.
That's intense.
Very high stakes market, especially from the business valuation front. And what we found when we started looking closer at the SBA market, a lot of the vendors, like the legacy vendors in the space, they're very old school, similar to what Ace saw when he was at Brown Forman. They're kind of building Excel models from scratch. They're copy and pasting the text over into a report. So that means there's not a ton of data going into it because it's all constrained by what someone's able to do in, say, a work of a week of the working time. It also means it's very expensive. You need specialized individuals preparing these reports. And so what that results in is it might cost $5,000. It might take 2 weeks or even 3 weeks to get this report back. And that's all while you don't really know if the loan is going to get approved or not, because the valuation might come in too low and it might cause the deal to fall apart. And so what we've done is we used a number of different kind of technology components to automate different pieces of that process. We've dropped that price down to $1,800 and the turn time down to 3 days or less. So about, half the cost and about 5 times faster than you would typically get with those legacy firms.
So the legacy firms are doing this the old fashioned way with, pen and paper, more or less, or PDFs, right? So they're kind of running their spreadsheet evaluations and turning it around in a couple of weeks and charging you $5,000. And it's like a professional service, more or less, like an appraisal.
Exactly. And because of that, they're not really assessing risk of the business, which is something that the business valuation at its core is designed to do for the loan. And they're not able to really look extensively at a lot of different data sources. It becomes a bit more hand wavy where you're like, it's a small business. The small business is a part of the US economy. So we're going to assume that every small business grows in line with the US economy, which obviously isn't the case. A lot of these deals, if you're getting SBA financing, a lot of times it's kind of the best of business acquisitions qualify for those loans. So most of those businesses are going to outpace the US economy. And there's dozens of assumptions like that go into an appraisal. And if you're doing it all manually, it's pretty limited on what data sources you can use to drive those assumptions.
Why do you think this wasn't done, 5 or 10 years ago? That's a big question I usually have as an investor. Kind of sounds like this all could have been done with the technology in 2015 or even 2010 versus 2025.
Yeah, so I think some of the technology components were there 10 years ago. I think the biggest barrier to entry is just the regulation in the banking space. It's very intimidating. Almost every investor call we'll get on, that's something that's brought up of like, typically we've heard it takes 2 years to get a contract with these banks. There's a lot of regulations, like what are you doing about data security, concerns like that. And I would say it's kind of a spectrum. So both on the types of banks you're working with, but also the types of services you're providing. So on services, you might have someone that's selling like office supplies to the bank. They might have to go through some vendor due diligence, but it's limited. But then you might also have like a know your customer kind of fintech company where they're integrating into the bank's systems, accessing all of their data. Someone like that might take years to get approved. There's all kinds of like SOC 2 compliance involved, things like that. And so because we aren't directly integrating into the bank system, all of the data is being sent directly to ValueBuddy. We're not getting it from their systems. Like the borrower is working with us directly. We're a bit further towards the less regulated side of that spectrum. And then the second component is the types of banks you're working with. So the top SBA lenders aren't necessarily like the big banks that you would think of. Chase, JP Morgan, Bank of America, Wells Fargo. Some of those do a decent amount of SBA lending, but the top names in the SBA world are like Live Oak Bank, Huntington, BayFirst, Lendistry, just slightly smaller banks in general. Some of them are even SBA only. That's like their only type of loan that they give out. And so that's one thing we've seen as well. Those SBA focused lenders have a little bit less regulation and less scrutiny placed on them than some of those really large banks. And so some of these banks, we might meet them. And because the pain points are so high with these legacy appraisers, and because there's a bit less regulation on the type of services we provide, we might start working with that bank 2 to 4 weeks after our initial meeting with them. Versus even for our services with like a Bank of America, that might take 18 to 24 months. But that's what makes the SBA so attractive, is that you can get your foot in the door in the SBA world. And there's a lot less regulation involved, and you're able to work with banks that are a bit more nimble than some of those larger banks.
So it's interesting. Yeah, so it's a good wedge. Get into the banks and start doing these valuations. And the value prop here is like, hey, you're spending $5,000 on these. Does that price scale with complexity, or is it kind of pretty much standard in the industry? It's roughly $5,000.
Yeah, so it varies a ton, and it's something that makes it even easier to sell into like smaller community banks, because a lot of times they're really kind of extorted on that pricing. Like we've heard people get quotes for $25,000 to value a business that's worth $1 million versus someone like a really high volume lender, like some of the ones I mentioned, they might be paying closer to $2,500 for their typical business valuation. And so, yeah, it ranges a lot based on the volume that you're purchasing, but also on the complexity of the business. And so that's something that banks have commented that they like with ValueBuddy, is that they know what the quote's going to come in at. We have flat pricing. Our systems are pretty dynamic to value different sized businesses. And so that's something they're able to market it even upfront, that our closing costs are $1,000 or $2,000 lower because we use this specific business valuation firm, and they know what that pricing looks like, versus it might be $2,000 or it might be $8,000, but we won't really know until a month into the I learned in grad school that there's primarily
two value props for businesses. It's like save them time and save them money, right? And so it sounds like you guys are doing both, which is like kind of the double whammy. So when you go to these banks, like, hey, you're paying $5,000 or more for these and they take a couple weeks, we could do that in a few days and it'll cost a fraction of that. You want to give it a shot? It's kind of like, yeah, I mean, I bet the close ratio is pretty high when you pitch it like that.
Yeah, I mean, if we meet the right person at a bank, there's only been a few situations where we're not currently working with that bank now. It's an offer that's pretty hard to turn down. And it's funny, yeah, you mentioned the price and then the saving them time and saving them time and money. And honestly, saving them time is vastly more important, especially for the high volume banks. They're trying to get these loans out the door. They're trying to get them closed. They're not in their fees that they're getting back on these loans are a lot higher than like the business valuation costs. So they're definitely focused on like volume and speed. And so the fact that we're able to help them with that definitely is a bigger factor than the price.
Yeah, that's pretty amazing. What are some of the biggest lessons you took away from consulting that helped you as a startup founder so far?
Yeah, I think it's, I guess, pretty general feedback, but I think one of the things that consulting really teaches you is to think with frameworks. It makes like learning new industries, every 2 weeks in the consulting world, it makes it a lot easier if you have frameworks in place to do that. It's the same way with, learning industries, learning about how to sell into accounts, how to prioritize accounts. Like all of that can be done using frameworks. So that you're not kind of every decision you make isn't starting from scratch, that you have like a general framework that you're thinking about solving the problem through.
Yeah, I love that. So another question that I'm putting my VC hat back on would be kind of market sizing. How do you think about the size of the market? And like I think people might go SBA loans, like how many of those are really done at $1,800 each per year? Is this a big market? How do you think about that?
Yeah, so the headline number that we cite is about a $4 billion market for our services. The SBA portion of that is only around 100 million. But the most important factor there is one, we're hyper focused on the SBA market to start. And because, like you mentioned, it's a wedge. A lot of these same banks are also doing conventional loans that need our services, but there's not necessarily a government requirement for the business valuation. But the fact that we're building our relationship through the SBA arm of that bank means that we have access to the rest of that market. About 25% of small business loans go for business acquisitions. So a little over 2 million loans per year to purchase a small business, and about 70,000 of those are SBA backed.
Yeah, so pretty significant wedge, and then you can kind of go upstream and cross stream. How do you think about expanding beyond SBA? Like what's next for you guys as you look out, 3 to 5 years from now?
Yeah, so after SBA, it would be the same services, but for conventional lending. So rather than a government guaranteed loan, you're just getting a conventional loan from someone like Chase. And so that's where that relationship really comes into play. It's really hard to get a bank to trust a new vendor. And so if we're able to build that relationship with the SBA team, that referral to the conventional lending team is much easier than a new vendor coming in. And so that's probably the most valuable thing that we're building, say over the next year or two, as we focus on the SBA market, is that relationship and that wedge into the banks. And then beyond that, there's some tangential markets that we also can focus on. So like business brokers, for instance. With the banks, it's more buy-side valuations of someone buying the business and getting funding for it. With brokers, it's more about the sell-side valuation. I think it's 80% of businesses that are listed for sale never actually sell. A lot of that is because of mispricing. I mean, you're just kind of plucking a number out of the air. You might have what they call a broker.
I think it's 5 million, and you're like, why 5 million? Like, because I think so. Yeah.
And even if the business isn't worth 5 million, like they don't even have a report, like a 50-page report explaining why it's worth 5 million. They don't really have an answer to that question. And so that leads to a lot of these baby boomer businesses. They build their whole life kind of building up what they view as their retirement fund. And a lot of time there isn't really an exit value. And so that's something we can help with if we help the brokers with the pricing of these businesses, but also having justification that the seller has answers when someone asks, why is it worth X? They could show, 7 different valuation methodologies, hundreds of thousands of data points that went into it. We help them kind of exit and make sure that they can get the right value for the business that they spent their life building.
How does it differ between kind of public stock analysis? I a long time ago, got CFA, worked on Wall Street, all that stuff. So I did mortgage-backed securities, which is a little different, but from an equity standpoint, you have a variety of valuation methods like discounted cash flows and things like that. How do you guys look at SBA loans? How is it similar to a public equity, like a publicly traded company? How is it different?
Yeah, so I think at its core, the things that drive value for a small business are very similar to a large business. Like DCF, for instance, that's a method we use.
Discounted cash flow, DCF.
Yeah, discounted cash flow.
For anybody listening who doesn't understand that. Yeah.
Yeah, so that's like the forward-looking, what we call an income approach. So it values the business based on its propensity to generate future cash flows or profits, and it discounts those back to the present. So like revenue or profit generated 10 years from now is worth less than profit generated tomorrow. It's a general premise of a discounted cash flow valuation. So that's something that's still used for small businesses.
And the increase in rates probably impacted that recently. And banks are aware of that. And, when you're discounting it at 2% versus, 5, 6, 7%, the discount rate affects the current valuation.
And for small businesses, that discount rate, that's something that is a lot different than in like an investment banking model. That discount rate is going to be a lot higher. The small businesses are just inherently more risky, and even their access to capital is a bit more limited. So like
interesting. So banks are, what is their typical discount rate? Is it kind of a LIBOR plus 3 or something? How are they setting that?
Yeah, so a lot of times it's the Wall Street Journal Prime plus about 2 to 3%. So I think today that's around 10.5, 11% interest on these loans.
Interesting. And so, generally, depending on your growth rate and churn rates and stuff like that, generally, like if you're discounting at 10% and you have $1 million of, call it EBITDA, you're generally worth about $10 million, plus or minus some margin of error. Is that kind of generally correct?
Not necessarily. So for small businesses, the valuation multiples are actually a lot lower. If you look at like middle market private equity, the EBITDA multiple would be about 8x versus for small businesses, it's like X.
Interesting.
So $1 million of EBITDA would translate to about 3.5 million. Obviously, a lot of nuance there and like the industry growth rates, things like that. But another difference.
What are some favorable SBA areas that banks tend to underwrite at a little higher EBITDA ratio versus ones they're kind of out of favor, even if the growth rates are the same?
This episode of the Ignite podcast is brought to you by our friends at Build, spelled BYLDD. Build is a development agency that specializes in helping early stage startups, especially non-technical founders and teams, build and launch scalable revenue-generating software products. Most startups don't have $100K to hand over to a big agency, and honestly, for your first product, you probably shouldn't. Sure, you could try rolling the dice on some freelancers, but that's a gamble with unclear costs and a lot of project management headaches and no guarantees. That's where Build comes in. For just $10K in about a month, Build can turn your validated idea into a real product that's ready to go to market. It's a smart, efficient way to build a foundation for a company of any size. And yes, companies that start with Build can and have scaled very large. Their clients have gone on to be backed by YC, Y Combinator, and Google, and raise funding at multi-million-dollar valuations. Ready to get started? Head over to build.com. Again, that's BYLDD, to connect to Ayush and the team and let him know you heard about Build on the Ignite podcast.
Honestly, more so than industry, it's the size of the business. So a lot of these SBA companies, they might be worth 350,000. And when you're looking at that small of a business, a lot of times it looks more like you're acquiring a job than a business. The owner is very important. There's a lot of key person risk. They might be working 60 hours a week. They have all the relationships with the customers. So for something like that, you're going to get a lot lower multiple versus a business that's 3 million with a team behind it. The owner might be completely absentee. So more so than industry, it's the size of the business can play a big role on what it's worth in the SBA space.
So this is all calculated in your model. So you take all these into account. And maybe you could, without giving away too much of how it works, maybe you could walk us through some of the mechanics of how your modeling works.
Yeah. So for the multiple approach, which is what we're discussing right now, what's interesting in the small business world, you actually look at something called SDE, seller's discretionary earnings. So it's all of the benefit if someone buys the business that the business could generate for the owner. So that's like one key component of that is you add back the owner's salary because that's part of the benefit stream that they derive from the business. And so this is a bit more of like the simplified valuation methodology is the multiple approach where you take a financial metric and you multiply it by a valuation multiple. And so those valuation multiples are from precedent transactions. So essentially our system will automatically go through all of the small business transaction databases and pull the multiples that are most relevant to that business. So things like the size of the business, the industry, the location, all of that's automatically factored in to create an accurate, what we call a comparable set. So a number of other companies that look very similar to that business and what they sold at.
Interesting. So you can actually pull some data, kind of like appraisers do for homes. Just look at the comps over the last 6 to 12 months and say, okay, this is kind of the range. And you can kind of hone in on this is basically what businesses are selling for in this area, in this industry, at this size, with these kind of characteristics.
Yeah. And so that's exactly like real estate. That's what we call the market approach. And then the alternative to that is the income approach, which is the discounted cash flow that we discussed earlier.
Interesting. And do you kind of output in your report? It's a 50-page report you mentioned. You're outputting all these options for them.
Yeah. And so that's part of what the model does is it determines which one's most applicable. And so for even the multiple valuations, we provide 5 different methods. We value it based on its sales, its EBITDA, SDE, et cetera. And so it also provides based on the type of business, which one of those methods is most relevant. So oftentimes it's the discounted cash flow in the SDE multiple. And then there's a weighting between
Tell me
those.
more about the STE multiple.
Yes, SDE was seller's discretionary earnings. It's similar to EBITDA. The main difference is that for small businesses, it adds back the salary that the owner takes from the business.
Interesting.
That's like the main financial metric for small business valuations, more so than EBITDA.
Interesting. Yeah, because usually it's the business owner here working there full time and taking a salary, sometimes running it as an S corp or like an elected S corp in an LLC. Or interesting. Yeah, it's an interesting mechanic there. So you're using AI. You call it AI powered valuation. How does that work, and what makes it better than traditional methods?
Yeah, so there's a number of different AI tools we use. When we say AI, it's not necessarily generative AI. So like for one, we have computer vision to automatically process the financials. In finance, it's called financial spreading. So taking something like a small business tax return and populating all of that data into the valuation model. So essentially data entry. And so computer vision is able to, with pretty much 100% accuracy, go through those tax returns and automate that process. So that alone, that's something that might take 4 hours to do manually. That's able to be done automatically with slightly higher accuracy than a human doing it. So like that's one example. Another way that we're using AI would be retrieval augmented generation. So RAG. As you can imagine, getting a 50 to 60 page valuation report, if you're a lender, you're not formally trained on business valuations. You don't have time to sit down and read that and kind of comprehend it. And so what RAG does is it breaks that 60 page report into small chunks, call it like a sentence. And then when you ask a question, it finds which of those sentences in that report are most relevant to your question. And then it feeds that into an LLM to help to limit things like hallucination and to ground it in like actual data from the report. And so that's just another way that we use AI to improve the business valuation process.
So now if you're an SBA lender sitting at a bank, you can ask ValueBuddy, well, why did we do it that way? Oh yeah, like on page 17 here, line 32, that's why.
Yeah. And even if you need things like, say, what was the EBITDA in 2021? That's something you could ask, and it would be able to feed that data into the LLM.
Another big time saver for them, right? So rather than digging through this 50-page report, and probably the average loan officer is like getting one of these approved every day. I don't know what the throughput is, but just so much paperwork to kind of get through. And now your platform's also enabling them to understand what's in the report and understand what's in the business at a even faster rate, which is another time saving for them, right?
And another thing as well is because they're not formally trained on it and don't necessarily have the time to digest the full report, customer service is not always the best. Of like, if you're a borrower, you might have paid $5,000 for this report, but you're lucky if they forward you the PDF, but like you're probably not going to be able to do like a Q&A on like, how was this calculated? Can you explain different valuation methods that were used, things like that? But that RAG technology enables them to have much better customer service. They could provide kind of automated, in-depth responses to any question the borrower has about that.
Interesting. So are lenders actually making this customer facing, these reports? I mean, they send them the PDF, obviously, but like your platform using the RAG and LLMs.
So today we don't offer that. Right now, they would just have to like paste the question into the RAG tool, but in the future, that's potentially something we're looking at offering. The borrowers could directly interact with that interface.
Wow. How do you balance this, AI and automation with human expertise to ensure the accuracy and compliance? Is that kind of why it takes a few days because it generates the report and somebody has to review it before you send it back to the bank?
Yeah, so every report has a human in the loop element. So we have our valuation director, Tim, has about a decade of experience working at the legacy firms preparing these reports. And so he reviews kind of every input, every output. And he also has his name like certifying the report. So we're not just kind of blindly sending a report generated by AI. All of the math and the fundamentals are checked by a human with expertise.
Yeah, I love that. What's a big misconception they have in this banks and lenders about the AI and underwriting?
A misconception, I think from like an education standpoint on AI, a lot of people see the headlines. They think AI means ChatGPT. There's a number of other types of technology like computer vision for financial spreading, like automating a lot of things like data entry, and also RAG as well, that you might hear about hallucinations, but that's not really a thing with RAG because it's based on like actual data from a specific source. And so there's a number of other types of AI technology beyond generative AI or like LLMs that are relevant to the banking space. So I'd say that's one of the big misconceptions.
Nice. What's been the biggest challenge in convincing banks to switch from legacy providers to ValueBuddy?
I think something we tell probably every investor that asks a similar question is that it's been kind of remarkably easy. When we were selling to the startups that we worked with initially, we felt like we were almost begging them to buy our services. There wasn't a real need. And so once we're able to say, like, we can save you time, we can save you money, even if they've had a 10-year relationship with those legacy appraisers, almost every time they'll switch over to ValueBuddy and at least try it out. And then once they try it out, we're saving them time and money, and they see that, and we just kind of grow rapidly within that account. So I'd say compared to some of the previous segments that we targeted, honestly, there aren't many challenges that we come across frequently.
As an investor, I love to hear that. So you brought on other investors like Techstars, Render, Capital, Keyhorse, not to mention Team Ignite. What advice do you have for founders raising early stage fintech capital like you guys have successfully done?
Yeah, so I think something a lot of investors may not tell you is that even pre-seed investments are starting to look more like a spreadsheet round instead of an idea round. You're going to need, especially in like the B2B space, you need at least one really solid customer that has testimonials and like actual feedback and ideally revenue generated. It's very hard to raise on an idea in this market.
Almost impossible. And I get into this back and forth with founders. Like, I thought you were pre-seed. I'm like, yeah, pre-seed basically means revenue now. It's like post-launch, post-revenue. I think you're thinking of friends and family, which is like, hey, you go to people that know you and trust you, and they'll give you some seed capital, basically $250K, call it, or K, because they know and trust you. And I've even had friends I've had to turn down, right? I'm like, yeah, great idea. Come back when you have revenue, right? That's our thesis. And I think that's kind of where you guys were when I met you guys. It was like, you guys were just starting to have like a referenceable customer, but it was really early.
Yeah, I think the first time we met, you were the first investor we ever spoke with. And we also had just closed our first customer like 2 weeks before that. So very limited kind of data to go off of from an investment decision.
Yeah, I like to say I like to invest in lines, not dots. And so like, yeah, you had a dot there, but you need to string some dots together to have a line. And you guys certainly did that. Any other takeaways for raising capital?
Yeah, I think accelerators can really bog down founders. In some situations, if you don't have a network, there could be some value there, but I don't think anything beats getting actual experience talking to customers and building a product, trying to solve their problems. I think that's going to outpace any accelerator that you participate in.
Interesting, because you're saying that as someone who did attend Techstars. So when should a founder attend an accelerator, and when shouldn't they?
Yeah, I mean, I think any accelerator that has positive ROI, that's going to be a pretty short list of accelerators. So I think especially if you don't have kind of a good brand name on your resume, if you didn't go to a top school, if you didn't come from a top company, having that stamp from an accelerator is probably one of the most valuable things they can add. Something like a Y Combinator, a lot of investors would view that as equivalent to like a Harvard MBA. Getting that credibility is really important. And if an accelerator is maybe industry focused, I think that's going to be a lot more valuable than a generalist accelerator. A generalist accelerator, they might have some VC connections, but it's unlikely, like if you're trying to sell to banks, that they're going to have an extensive banking network.
So try to find a niche one that suits your business. If you can't get into like a YC or Techstars.
Yeah, and there's a number of, like, in our space, there's a lot of bank tech accelerators, and something like that is going to give you a lot more value than kind of just any random generalist accelerator.
Speaking of, what's been hardest in building credibility in this sector in financial services as a startup?
Yeah, so something I've tried to focus on a lot, and even just the last couple of months, is building a personal brand. And so, especially in the B2B space, a lot of times we'll get off of a call and you can see on LinkedIn, like, hey, this person you just got off the call with viewed your company page, and then they viewed all of your employees' individual pages. So building a personal brand on LinkedIn, especially in the B2B space, is incredibly important. Basically free to do, and it's a lot more valuable than running like paid ads or anything else to try to build credibility. I saw something a couple months ago. It was a quote saying, you can be a thought leader in your niche with only 100 LinkedIn posts. So if you're making 5 posts a day, that's 20 weeks to be viewed as a thought leader in your space. Not to mention all the value that kind of aggregating all of those insights and writing about them every day, you're going to learn a ton about your industry and your customers.
Yeah, it makes sense. So what's next for ValueBuddy as you look out, 10 years from now, like kind of taking the very long-term, horizon? Imagine you're ringing the NASDAQ bell 10, 15 years from now. What did you guys build and why are you so proud of it?
Yeah, so our goal is first step would be kind of expanding outside of SBA lending, so to conventional lending. That might be our 3 to 5 year plan. Beyond that is building other tools to help with loan origination, so other underwriting tools, and providing a whole suite of tools to fund small businesses. That's what we really see as the value. And that's why we're so focused today on building those relationships with the bank so that we can sell those other solutions to support other pain points that they have in parts of the loan origination process.
Fascinating. Well, let's wrap up with a rapid fire.
Let's do it.
What's the biggest mistake small business buyers make when acquiring a company?
Something I talk a lot about on LinkedIn is insufficient working capital. And what that means is having cash after like post acquisition to maintain payroll and things like that. In small business acquisitions, you see something called the J curve. A lot of times there's a small kind of downturn in revenue and things like that as the new buyer is learning the business before there's an uptick. And so you need sufficient working capital to weather that J curve.
How long is the J curve?
Typically, it's about a year for a small business to learn the process and to rebuild things like customer relationships that might leave with the previous owner.
Yeah, interesting. And do you guys include that in your underwriting? You're like, okay, we think post acquisition here, they should have this amount of money in the bank.
So it's an adjustment we make in the report. If a business has insufficient working capital, that value is deducted from the business, assuming that the new buyer has to inject capital. But ultimately, like whether the bank includes working capital or not is up to their discretion.
Yeah, interesting. What's a book every fintech founder should read?
Yeah, so along the lines of personal branding, this one isn't fintech specific necessarily, but there's a book called The LinkedIn Branding Book. It's a short book. It just kind of gives you some feedback on what types of posts resonate with your audience, how to build like a small, really niche community that drives a lot of value. Because building a personal brand on LinkedIn doesn't necessarily have to look like getting 1,000 likes and going viral. You could be getting 20 likes on every post. And if it puts you as a thought leader in that small niche of the market, you can be generating millions of dollars from that.
Yeah, I mean, that's how we've grown Team Ignite. I mean, certainly big fans of LinkedIn. My partner worked there for 7 years. So yeah, we obviously care about their success. What's your go-to KPI for tracking ValueBuddy success?
A short-term KPI that we're putting a lot of focus on is actually account penetration. So in like my consulting background, that's something that we would advise a lot of clients on. A lot of times you'd see companies focusing on logo growth, but you might only have 10% penetration in some large accounts. It's a lot more capital efficient to drive penetration in those big accounts than to go out and try to find new customers. And so especially in our space where we've started to work with some large banks, we're a lot more focused on getting repeat and additional revenue from those banks than adding new banks to our customer list.
That makes sense. AI in finance, biggest opportunity or biggest risk?
Yeah, so I think one of the biggest opportunities is RAG, like I mentioned earlier, retrieval augmented generation. It's not just the business valuation that's dense and wordy. We might have a 60-page report, but the total loan file with all of the other documents looks something like 300 pages typically. So there's a lot of need for AI to be able to process those documents and provide accurate responses based on them.
Love it. Who's a fintech leader you admire and why?
Yeah, so I think probably who I admire the most would be the PayPal founding team. They built PayPal Mafia. And I think what's most remarkable there is the quality of the team that they built. A founder only takes a business so far. It's really about the people that they surround themselves with. So I think Max Levchin, he's gone on to found some other successful companies as well. But
Yeah, Peter
I really
Thiel,
admire
Elon
the team.
Musk, all those guys. Technically, that was a merger. Elon had a competing X. It was X.com. Fascinating story. What's one regulation you wish you could change or would change in small business lending?
Yeah, so this is really specific, but for the SBA, there's a limit of a $5 million loan cap that was set in about 2010, so around 15 years ago.
Oh, wow.
It hasn't been updated since. As you can imagine, like inflation and with the small businesses growing, a business that was worth 5 million 15 years ago is worth 8 to 10 million now. And so that's something that I would change, just kind of a dearth of capital in that 10 to like 20 million range before, or I'd say even 5 to 20 million before private equity comes in.
Yeah, so it's a little dip between big enough for private equity, but too big for SBA. What are the implications when you're buying an $8 to $10 million business that's kind of stuck in that valley?
Yeah, so
there's selling one.
There's something called a pari passu loan. So essentially you take a $5 million loan and then whatever additional capital is needed on top of that, you pair it with a conventional loan with the same terms. It's a pretty complicated process and it would be unnecessary if the SBA increased their $5 million cap to something like 10 million.
And is that because, so the government's basically guaranteeing a portion of that SBA loan, kind of like Fannie Mae and Freddie Mac does?
Yeah, so their maximum liability on a 5 million loan is 3.75 million. It would literally take an act of Congress to increase the 5 million cap, which is why it hasn't happened. But yeah, some mechanism to increase it and have it keep up with inflation would be the one thing I don't know
why we keep getting into these situations in the government. Why don't they just, every time they set a cap, just be like, okay, now it's tied to some index or it's tied to some measure of inflation. So it's 5 and it floats based on inflation. Because inflation's kind of, the target's going to be 2 to 3% a year. And so, everything deflates by, roughly half every 30 years, 36 years, rule 72. Like, why haven't they got that figured out yet?
Yeah, that's something I don't have the answer to.
Fix this policy, Cameron. What's a startup outside of fintech that you're excited about?
Yeah, this one might be a little basic now, but I would say Bolt. It's become one of the VC darlings where it's gone, I think, to 20 or 30 million in ARR in a few months. I was actually recommended to try it out. I guess I was one of the first users because that was a few months ago. It makes coding a platform very easy. in the time it took to record this podcast, you could build a pretty sophisticated app with a nice interface.
That's amazing. What's an emerging trend in AI you think is overhyped?
I would say AI agents, only because like a lot of other technologies, things are called agents that aren't truly AI agents. It's becoming a buzzword that you can slap on a startup to make it sound a bit more attractive. The underlying technology, I think, is really promising. It's just what actually constitutes an AI agent versus who's using it as a buzzword.
Yeah, amazing. And what's your boldest fintech prediction for the next 5 years?
Yeah, I would say that the death of traditional credit scores, especially for like business lending, for instance. I think with AI, there's a lot of opportunity to match that credit scoring system to the bank's actual credit box and which factors they care about versus having a more generalist credit score.
Amazing. Well, where can folks find you guys online if you're a bank or a small business that needs to get in touch?
Yeah, so you can find us at hellovaluebuddy.com. I'm on LinkedIn as Cameron Long, or recently actually made an X account, Cameron Long HQ.
Awesome. Well, thanks so much for coming on. Really appreciate it.
Thank you for having me, Brian.